The Acquirer's Multiple is a book written by Tobias Carlisle, and it looks at an investment strategy that is really easy to follow and has incredible results. And if you're looking for a set of rules to follow that doesn't take much time and is really simple to follow, well, this might be the perfect strategy for you. It's a fantastic book and I highly recommend getting a copy because it's an easy read, but if you haven't read the book yet, don't worry. Today I'm going to go through and do an evaluation of the strategy itself and pull apart the key points. I think the biggest takeaway that the book clearly explains is this idea of mean reversion. So the idea of mean reversion is that companies that are under fair value eventually move back to fair value, and companies that are over fair value also eventually move back to fair value. So if company A is $15 and its fair value is actually $20, well, then we compare that to company B that is currently $10, but the fair value is $30. Well, there is obviously a lot more money to be made in company B because going from $10 to $30 is a lot further to go. So that's essentially what we're trying to do here in this book and in this strategy, and it's also what I try to do as an investor as well. Now, a lot of times in this video, I'm going to be comparing the Acquirer's Multiple by Tobias Carlisle against the Magic Formula by Joel Greenblatt. Now, I'm comparing these two because they're both very famous strategies and both don't require a lot of time and effort to implement. Plus, they are both scientific methods for stock picking and they are also value investing strategies. So the key difference between the Magic Formula and the Acquirer's Multiple is this. So the concept behind the Magic Formula is to find a list of companies that are both undervalued and good quality companies. And the Magic Formula attempts to find these wonderful companies at fair prices. Whereas the Acquirer's Multiple, well, the Acquirer's Multiple is even more simple, and it's just finding companies that are just seriously undervalued, regardless of their quality. The Acquirer's Multiple attempts to find fair companies at wonderful prices. So it sounds very simple. Now, a very popular and normal way to look at whether a company is undervalued is to look at what's called the PE ratio. You've probably heard of this. The PE ratio is actually really simple to calculate. It's just simply the price of the stock divided by the earnings per share of the company. So if the company's share price is $10 per share and they're making $1.50 earnings per share, well, that's $10 divided by $1.50, which equals 6.66666. So the PE ratio is 6.66. So if we bought the shares at $10 of this company, well, it would take, with current earnings, it would take 6.66 years to make our $10 investment back. So the lower the PE ratio, the more undervalued the company. Now the Acquirer's Multiple, well, it takes the PE ratio to a new level. And in my opinion, it's a far better representation of value. Because what the Acquirer's Multiple will do, well, it'll also factor in the cash in the bank and how much debt the company has, which is very important. And we definitely need to be taking that into account when looking at value. Okay, now this is my attempt to make this as simple as possible for you to understand. So the Acquirer's Multiple formula is enterprise value divided by operating earnings. Now let's talk about what each of these are. See, the enterprise value is the price that you pay. This is different to market cap. Now, market cap is generally the cost to buy all of the shares. Now, the market cap moves a lot because the share price moves a lot. Now, the market cap is different to the enterprise value. See, the enterprise value tells us how much it would cost to buy all of the company's shares and all of the company's debt. Because when you buy a company, you have to buy the debt as well. But you also get the cash in the company's bank account. The enterprise value, well, it moves with the share price like the market cap does, but it has factored in the debt and the cash. So a company that has higher debt is also going to have a higher enterprise value. Now try to think about this as buying the entire company. Now, don't think of it as just like a part of the company or shares or anything like that. Think of it like a takeover. So if you're going to buy, like, I don't know, the coffee shop next door, well, you're going to have to buy out the owners of that company. So that's going to cost you something. But then let's say they've got a mortgage on the property. Well, you also have to have the money to buy out that debt as well. So let's say we have two identical companies. Both are, I don't know, t-shirt manufacturers making the same t-shirt and have the same sales, the same costs, everything's the same. So company A, let's look at it first. It has a share price of $5 per share. They have 1 million shares outstanding and they have $3 million of debt. They also have $2 million of cash in the bank. So their market cap is going to be $5 per share times the 1 million shares they have outstanding. So that equals $5 million. That's their market cap. Now that differs to enterprise value, where you got the $5 share price times the 1 million shares, but then you add on the debt and take away the cash in the bank. That gives you an enterprise value of $6 million. Now let's look at company B. Their share price is also $5 and they also have 1 million shares outstanding. But this time they don't have any debt, but they've still got the $2 million cash in the bank. Now the market cap is exactly the same as company A at $5 million because they have the same shares outstanding and the same share price. But the enterprise value is different because $5 times 1 million is still 5 million plus the debt of $0 minus the cash in the bank. So their enterprise value is only $3 million. So company A has a higher enterprise value of $6 million compared to company B of $3 million. So the $3 million, well, that's a lot cheaper than $6 million. I would prefer to buy company B because it's only $3 million. So some companies have huge amounts of debt and some companies have no debt at all and huge amounts of cash. And when we compare them all, well, it's actually far better to use enterprise value than it is to use market cap because we're factoring in that cash and that debt. And remember, lower enterprise value is good for us. That's a better deal. Now, the other component of the formula is operating earnings. Now, operating earnings is actually really simple to understand. It is the money that flows into the business just from the operations. This is not including any one-off items or tax or anything like that. So now back to the acquirer's multiple. Now we know what the enterprise value is now, and we know what operating earnings is now. The lower this acquirer's multiple number, the better. And now we can compare companies against each other and rank them. Company A. It had an enterprise value of $6 million. It has operating earnings of $1 million. So it has an acquirer's multiple of 6. $6 million divided by 1 million. Then we compare that to company B. And remember, its enterprise value was $3 million. It has the same operating earnings of $1 million as well. So its acquirer's multiple is 3. Now remember, the lower acquirer's multiple, the better. So company B, well, we've already decided it was better than company A anyway. But what if company A started making more money? Because they put their prices up and it didn't affect their sales. So now they're making $2.5 million in operating earnings. So company A still has an enterprise value of $6 million, but their operating earnings has improved to $2.5 million. So now their acquirer's multiple is 2.4. And that's why we don't look at just the enterprise value. We also have to factor in the operating earnings. And company A looks like a very attractive investment right now because it will only take 2.4 years to make back our initial investment. And we have factored in the debt. See how it is very similar to a PE ratio, but I think it's far better. Now we can go off and give every company in the entire stock market an acquirer's multiple number. And the lower acquirer's multiple that we find, well, the better value that we're getting. And we're also factoring in the debt, which is good. Now, Tobias Carlisle is a fellow Australian and runs the Equium Investment Fund. He was a lawyer specializing in mergers and acquisitions in Australia, the US, UK, and many other countries. Now, I like Tobias Carlisle because he uses scientific and data-backed research, but it's not that complicated at all. The acquirer's multiple, in my opinion, is very sensible and logical. Now, the acquirer's multiple investment strategy is actually pretty much the exact same as the magic formula investment strategy. So the strategy is to follow this process. So you rank all of the companies and give them an acquirer's multiple ranking. And then you buy 2 or 3 positions each month in the top 20 to 30 companies over the course of the year. Each year, you then rebalance the portfolio by selling off losers 1 week before the year term ends and sell off winners 1 week after the year mark. You do this because this is a tax strategy for minimizing the capital gains tax that you're going to pay. Now you repeat the process each year for a minimum of 5 to 10 years or hopefully more. Now in the book, the back-tested period was from 1973 to 2017, which is a good sample and a larger sample size than the magic formula tested. Now if we look at the first 10 years between the acquirer's multiple and the magic formula, well, the results are practically the same. But what is happening here is compound interest at work. The difference was only about 2%. About 15% for the magic formula and 17% for the acquirer's multiple. That doesn't sound like much, and it isn't, but over 40 to 50 years, the compound effect of that extra 2% is really dramatic. Now, Tobias Carlisle also checked another group of the acquirer's multiple stocks, this time the best 30 that are over $200 million, not $1 billion like the one before. Now, this didn't perform as well and was only very slightly above the magic formula. It was less than 1% difference. Now, this is where the biggest, most dramatic difference occurred. This is the acquirer's multiple working with companies larger than $50 million. In all 3 examples, the magic formula and the acquirer's multiple completely smashed the S&P 500. But the acquirer's multiple was better again than the magic formula. So you might be wondering, why doesn't everyone just follow this exact same strategy? It obviously works, but I just want to highlight some very, very important things. See, if you invested in 2004 and followed the rules exactly, well, in 2009, you would have the exact same value as the S&P 500 over that same period of time. So you could have gone through all of this work, and for 5 years, you had really no return at all. Now, this just shows you how difficult it is to believe in a strategy and why so many people just can't implement it over the long term. Because if you did start in 2004, well, in 2009, you probably have lost a lot of respect for the strategy because you've got nowhere. But if you did get through this difficult period and you did trust the strategy, well, not only would you have smashed the S&P 500 over the longer term, well, you would have beat pretty much every other investment strategy out there. So it is clear with the back-tested data that over a long period of time, this strategy definitely works, but it is so difficult to mentally stay with it for that period of time. And because it's so mentally challenging to stick to, well, the strategy is probably always going to work because so many people aren't going to be able to do it for the long term. Therefore, you'll have an advantage. And this is the Acquirers Multiple website, and this is where we're going to use the screening tools that are here. Now, if I go into the screening section here on the website, what it's going to give me are, well, the only free version I can use is the large cap stocks. So it's only the largest 1,000 companies that it's going to screen for us using the Acquirers Multiple. Now you can sign up and use these other screen options here, which is probably not a bad idea. I haven't done that yet. I'm just going to show you the free version for today. So this screen is going to show us the top 30 companies in the Acquirers Multiple Large Cap 1000 universe, which is drawn from the largest 1,000 US exchange traded stocks and ADRs, excluding financials and utilities. Okay, let's go have a look. So here we go. The Acquirers Multiple number here is on the left, and it's ranked according to the Acquirers Multiple. Being lower is better. So we have Turkcell, which is a Turkish, Ukrainian, Georgian telephone communication company. I'm actually quite familiar with this company. We've got Rio Tinto, BHP, which are Australian-based companies, which I know very well. A lot of other companies here. Here's Biogen. Man, that comes up on nearly every screen that I do at the moment. And we got HP, like Hewlett-Packard. That's interesting. Xerox, I've seen that in a few screens recently as well. Here's Intel as well. Anyway, here's a list of, they've got 30 companies here. These are the 30 best out of those 1,000. Now, what I can do is actually download the CSV file here. This is just a little trick. Now I've just copied the ticker symbols. Now I move over to the Finvis stock screener. And if you haven't seen my video on the Finvis stock screening tutorial, well, I highly recommend going and watching that. This tool is very helpful. Now what I can do with all of those ticker symbols is I can just literally paste them in here where it says tickers and press search. And it's going to give me, well, here they are. Here was 20 at the moment, but it goes over into the second page. The 30 companies that the Acquirers Multiple already screened out for us. So from here, I can do extra screening. So maybe I want a debt to equity, and I like that to be, say, under a 0.7. I feel like debt to equity is an important number. So let's filter them out by that. So that's left me a list of 14 companies. Now this is very interesting. I might go through each one of these 14 companies, rule them out for whatever reason, maybe like this Indonesian one here. Look, I don't know anything about the Indonesian market, so maybe I just cut that one out. I don't really know much about the South African gold market either, so cut that one out as well. And I'll have a list here of companies that meet the Acquirers Multiple at the moment and have a low debt to equity ratio. So how I use this screen is to get ideas for further research. Now, unfortunately, it does have some disadvantages in this strategy because I'm going to rule out some of these companies for whatever reason, like that Indonesian company or that South African company. But they might be the companies that completely explode and go 100x. I have no idea. The easier decision is to just trust the back-tested data, invest in all of them, and just back it in for the long term. Now, I know the science is staring me in the face, but honestly, I'm just still undecided because I just don't believe there is a perfect formula out there that exists. Definitely read the book for a better understanding, and I'll leave a link in the description. I hope you enjoyed this video. Make sure you hit the like button for me, and I will see you next time.